level that we've highlighted on the higher time frame. Okay, and we moved into a consolidation. Okay, now prior to this move down here, okay, the range was this low and this high. All of this consolidation in here, if you look at the highs in here, we have short-term little resistance levels. Since we moved into this higher level time frame uh, buy area, okay, where we'd anticipate buyers coming in to maybe even cover their long-term shorts from like 170, 180 to around that 172 level on cable, that would be a big area to take some profits on that long-term multiple leg price leg lower. When we said we're looking at bounces in the bear market, again, the idea is look for highs where stops would reside. Okay, and here's your highs right in here. See how they're relatively clean. So if you look at that, when we look at the higher time frame price charts, these are the concepts and ideas that we look for to flesh out the idea of directional premise, how to frame our trades, how to build a directional bias, or trade within a predisposed range or defined range, if you will. Now, looking at what we have here, price moves on up and cleared these levels in here. But more importantly, when it ran up higher, it didn't take out this high. We don't need it to take out this high. Look through the candle. Okay, you see this area of consolidation? We went from big ranges. What happened in here? Range contraction. What's going to take place after range contraction? Range expansion. Move lower. Prior to this move going lower, okay, we had this down move in here. Okay, now watch. Remember I was just discussing a couple minutes ago how we actually look at candles and bodies wicks. This is what you would view. Well, let me just actually use this. This is actually better. I'm going to take this box, a rectangle, and I'm going to put it at the bottom of the body of the down candle right in here. Because remember, prior to this move up, it's the down candle, okay, that creates the buyers, and they come in the marketplace and it rallies up. If it fails and goes through it, it's the wick to the base of the candle that's down. Okay, in other words, we're doing this right there. See that? Now, if you extend that, there's your dynamic resistance. Okay, you see the flip-flop that's really necessary. The camp that teaches above the candle's bodies up to the wicks is dynamic resistance. That's nonsense. Okay, the likelihood of those instances unfolding are so few and far between, you would hardly get any kind of real good setups. And you certainly aren't seeing institutional order flow like that. You're seeing the absolute extremes in those moves, and you're not going to see a lot of trading in that. Okay, the bulk of the trading is in the body of the candle. That's why we define our bearish and bullish order blocks with the body's candle and the very low, or the body of the candle and the very high, based on whether it's a bullish or bearish order block. Okay. Now, again, this will all make more sense to you when we start giving you actual trading patterns and such in volumes 9, 10, 11, 12. But for now, understand this is where we would expect price to reach up into, cutting through a candle. Again, this is not supply and demand, guys. This is where there was old buyers back here, okay, and it went up, yes, but then went lower ultimately. It stayed below this level for a long period of time, and this is the first opportunity price got back up to it for them to mitigate that position. Now they're not in a net losing position, okay? Now, this is what we blend together to define trade ideas using higher time frame price charts. If we understand that there is a bullish scenario like this, we're in an area where we didn't anticipate a buying opportunity down here on a higher time frame, and we have old lows like this, okay, because this is an old daily low. We had this noted on Twitter. I tweeted this as a suggestion to study. Okay, here's an old low. Plot that on your chart. Okay, and then let's study what unfolds going forward. We're going to look at this price action in here. Price dipped below it, yes, but watch what happens. We're going to keep this in here. But we're going to change the chart to an open, high, low, close. Okay, and we're now going to introduce a revised, well, not revised, but a revisiting of Power 3. Power of 3 is my ICT accumulation to distribution concept, and this is really one of the things that I believe put me over the edge with what I learned from my mentor, Larry Williams. Um, Larry had this idea that, you know, he taught very early on, back in the 70s, that the opening price is very, very important. And on big range days, very rarely does it work both sides of the opening price a whole lot before it takes off. Generally, what will happen is it'll open, move up or down a little bit, okay, and then once it makes its low, whatever it would be, and he doesn't have anything to really define that, and that's where I came in and filled that void. Um, because I didn't feel comfortable with that. I was thinking to myself, here's this guy, he has all this insight, but he's admitting a, a, a deficit in understanding, and he had no problems admitting it. And he has obviously made lots of money without needing to know that. But what I'm about to share with you just was problematic for me. Um, his entry patterns, a lot of it requires buying on strength and selling on weakness. So what he does is in his day trading and in short-term entries is if he has an idea where he expects bullishness, okay, maybe he identified some accumulation, and we're going to talk about accumulation in a few minutes. But the opening price, his idea is that if it goes down and starts to rally up, once it goes 20%, okay, of the daily range, okay, the average daily range, if it goes 20% of the average daily range above the opening price, that's when he's going to buy. And he's going to use like a $2,500 stop on the S&P and whatever contracts that will allow him to do that. That was his money management, and then boom, there it is. Okay. Now my question is, knowing what you know already, does that sound like something you would feel comfortable doing? You're buying it after it's already moved. It doesn't make any sense. So what I did was I used his understanding of what he taught was the open on big ranges were usually at the opposite extremes of the range and the close. In other words, what I'm saying is on up days, the close will be at or near the low of the day, and the close will be at or near the high of the day. And you can see that pretty much is what's happening here. Okay, the close is above the opening on up days, as you would expect, but the price action below the opening, that to me is what separates the elite from those individuals that don't look at price like that. Okay, and that insight is what was garnered by me when I rubbed elbows with the banking industry. And when you get the understanding of what they're doing below that opening price, everything falls into place. Now, the opening price is defined by the new day, 0 GMT, and this is the real important one for me, midnight New York time. Now, I'm not going to argue with everyone around the world that wants to say that's not the new day, okay, but I've already shown many, many times how midnight, if you look at the opening price on the midnight candle, New York time, that to me is the that's like the bones, if you will. Okay, I mean that's it. You want to be looking at that, and we're going to look at that here. We understand that we went down into an old low here, okay, and we're going to look at the idea of what takes place each day, and we're going to go down to a 15-minute time frame. Okay, we have a 15-minute chart on the British pound USD, and this is obviously what took place last week. And these levels here are that order block that we noted. It's just in a little bit different color now. It used to be that red range that was extended out in time, and this is where it moved up into. So this was where price institutionally on a higher time frame would be reaching to. So from where we were at the beginning of the week, based on this old low on a daily chart down here, which is what we have here. I believe it's 146.37. Let's actually do that because that's really what the price was. So when we're down at that level, okay, we would anticipate price moving higher, simply on the idea that that would be an old area of institutional interest for buyers. Okay, and we're going to actually build in some understanding of accumulation, as you saw on my Twitter account, but probably wasn't really clear when I shared it in that video as well. I drew some lines. I'm actually going to talk about what it is that you should see for accumulation distribution. Excuse me. The idea is, okay, we have Sunday's trading here, and then Monday we opened and traded down, made a low, and optimal trade entry in here, retracement, and then rally up, closed higher on the day. Here is Tuesday. Tuesday we teach is the highest probability for making the low of the week if you're bullish. Okay, Tuesday's London Open. If not, it'll be Wednesday's London Open. Well, you got two really good opportunities here because here's Tuesday and here's Wednesday, both London Open trades. Okay, but now watch what happens. Assume for a moment we use what my mentor was teaching and still teaches today, and he's actually retiring in October of 2015, the time of his most recent like public announcement to the trading universe. He's actually not trading anymore in October 2015. So looking at what he suggests, he likes to buy 20% of the average daily range added to the opening price, and then that's when he'll be a buyer. Well, if let's say the opening price is here, okay, and that would be, maybe we're just going to rough it and say he's buying up here. To me, that doesn't make any sense. Now, does it work? Sure. In this case, it does. But it comes right back down to, if you're holding on to it, to about the general area, maybe even a little bit lower than when he would have been buying. My question is this: why wouldn't it be more, you know, likely to, let's say we use this level right here, and again, it doesn't have to be that precise to really communicate the effectiveness of it. And here we'll use this. Okay. Now, what I'm suggesting to you is this. Power 3 says the opening and a down move away from the opening, if we're overall bullish, that's what we're looking for. We want to see this move here. That's the Judas swing. This down move is the little piece of price action in up days where you see the opening price where it opens down a little bit and then it makes that real big move up and then closes high on the day. To me, when he made this comment, and you've heard me say this a lot, he made this comment in one of his seminars that he wished he knew just the zip code of the folks that were buying down here, and then maybe that would help. And it was kind of like a glib, you know, backhanded statement. But the long and short of it is I said, well, yeah, I'll take that as a challenge. If he doesn't know that, I'm going to purpose my trading around learning what is going on. How do they do that? And as fate would have it, because of my own tenacity and just really drilling that charts over and over and over again. And then finally, a communication I had with a guy in the banking industry. Some of the things that he said. Now, he did not say this is what we do. Now, I just came away with it has to be what they do, because if they buy when the market's down, this is what they're doing. They're buying when the market's down prior to the move up. They buy when the market's moving against the overall intended direction of their trade. Okay, so they're buying at the most VIP pricing there is. And then when I got with studying forex, and I applied time of day, which obviously the London session creates the higher low of the day on average, 80% of the time. The other 20% is usually in the New York session. If you look at this idea of the opening price, and this is what we're depicting here roughly, and I guess if I was fair about it and zoomed in, we're going to look at this day here. This is the Wednesday of the last week, and it would be the opening price up here if you used new day 0 GMT. If you did that, you'd have to be a buyer at this level or less. Okay, and on this day here, you'd have to be a buyer from this point here or less. Okay, so you'd have to be a buyer on a limit of this price or lower. Okay, now I'm gonna give you a little bit of a challenge. Okay, and we'll talk more about this in terms of trading plans and approaches. A lot of folks don't want to be up around London Open because they can't in North America. They got jobs, they whatever. They can't trade. They can't intraday entry for their trades around that time of day. So they're kind of like forced to do limit orders, sometimes missing trades or getting blown out, or only trading in New York or Asia. Of all times, really, you shouldn't be trading Asia unless you're doing yen or Aussie pairs. But if you trade with a higher time frame premise in mind, okay, you can have 100 pip stop trading plan and use this idea that at the opening price, okay, you want to be a buyer. And let's just say, for instance, you want to be a buyer 20 pips below the opening price when it's overall bullish. Okay. And from that point on, you would have a stop loss 100 pips below that entry point. So in essence, it would be 120 pips away from the opening price. What's the opening price? Well, you would know what that opening price is at 0 GMT. Now, 100 pips stop, okay, in this instance, 100 pips risked. If you did that, let's just, and this is just one example. It's not, don't build the idea that's always like this, but let's say, for instance, that you were buying it here. Actually, let me just use this. Say you were buying it around here. That right there is 100. That right there is your 1-to-1. So you would have a risk of 100 pips. Once it moved to there, you would have 1-to-1. There is 2-to-1. 3-to-1 is right there. And once we got up into this area here, it's 400 pips there. So there's your 4-to-1 trade based on a higher time frame premise, understanding institutional order flow, the idea of expecting some buying down in here, old daily low, buying below the opening price, using a 100 pip stop, not needing to be a day trader, not needing to be awake during London session, not needing to be so precise that you want to be ICT clone. Okay, you don't need all that stuff, and that's why many times I don't want to give you my trades specifically, because it builds this unrealistic expectation that you have to be just like me and you're never going to trade like me. Many of you, realize it or not, you're going to actually become better traders than I am. And it probably sounds like a farce me saying that, but I'm telling you, it's going to happen. And I believe, and I'm going to say this, and I'm probably going to get all kinds of backlash, but I believe I am a way better trader than Larry Williams. I love him as my mentor, but I have grown and evolved beyond the level that he admits in his own trading. In his own trading, if you look on the internet, Google it, you can see some of his screenshots that where he's entering. He's doing exactly what I just told you. He's buying well above the opening price. When I teach that you're buying below the opening price, when you're expecting bullish prices, it doesn't take long to look at a daily chart, put it open a high low close, and you'll see there's a small little movement below the opening price. That little movement is small in comparison to the overall expansion of that daily range. And here's the thing, what we discussed here, okay, if you were holding on to that and didn't do any scaling, there's a 4-to-1 setup right there. Let me ask you a question. If you were trading with this approach, okay, and you had this idea to do this like on a weekly basis, okay, and you were able to do it with multiple pairs, okay, you can do it like with a portfolio perspective. You can trade 1% risk, so you would have 4-to-1. You could risk 1%, you'd make 4% there. What if you did that every week? That's 16% compounded every month. It doesn't take long to grow a lot of money making 16%. And you're not a day trader. You're not trying to be in there and split hairs on every little minute detail and not even worrying about market maker profiles. You see what I'm saying? I'm giving you all kinds of tools and concepts, but you don't have to use every single one of them. You just got to find what it is that you're trying to do. Well, how's it fit for you and your trading? Because not all of us can be day traders. Not all of us can be short-term traders. Some of us can't be position traders. It's just a matter of taking the tools and understanding it and blending it in such a way where it makes it useful to you and you can profit with it. You don't have to use every single tool, but understanding the power 3 with this concept leading to higher level time frame areas of institutional interest, this is where we would be aiming. And as luck would have it, I don't believe so, Friday is where we would see the range completion, Thursday or Friday, and it makes it here. Boom. Now, let's take a closer look and apply time and price theory. Again, we have consolidation here. Market comes down and rallies up. Rallies away from a little consolidation right in here. We taught in Market Maker 6 and 7 the buy profile and sell profile, Market Maker, both instances. Okay, and my question to you is this: if we understand price, actually, let's go back out to a 15-minute chart. If we are looking at price here, okay, consolidating, and it rallies up, when did we talk about looking for market maker sell profiles? When it moves up into a higher time frame resistance, right? Would this area that we identified earlier, would that not be an example of that? Sure, it would. Absolutely. And you probably already see it, but here's the consolidation, okay, or during the initial accumulation, the initial runaway, okay, and then reaccumulation, moving up into smart money reversal, the low risk short, the break in market structure here, the redistribution back down into the initial area of accumulation. Now, it did not break it here, but we don't always see that. It rallied again, moved back up into what? This old area of redistribution. And here's the thing, look at this down candle. Institutional pricing, using institutional order flow, down candle prior to the move up. They were the buyers here, right? See that? Right here. Now watch if we extend it. Market moves right up into it, sell it. They were buyers here. We're on the distribution side of the cycle. So you want to sell it here. And if we go out to a 30-minute chart, just for clarity and visibility sake, and we'll take out the day dividers. Okay, you can see the consolidation here, accumulation of shorts, breakdown, redistribution, run to support, smart money reversal, low risk buy, reaccumulation, moved on up into clearing out the original accumulation point here, and where they distribute those positions as well. Okay, so when we're looking at higher time frame charts, we're looking for areas of interest on the institutional level. We're looking for areas of liquidity, but we're more importantly, when we identify these higher time frame price points, like we have here, this old low on the daily chart, 146.37, and an area where institutional interest would be residing, what we have defined is this. We defined a range at which price should expand in, and it gives you what? A directional premise. And you maintain that directional premise, okay, until it clearly breaks down and indicates that it's not going to happen, okay, and you stick with it. So even though we were buying in a down market, we understand how we look for stops, higher level interest reaction points where we can anticipate institutional order flow to come in the marketplace, as we see here, okay, and we wait for that to unfold each day using power 3, and not even necessary to be in there day trading, okay, but having the mindset of utilizing higher, wider stop and still being able to be a participant in these types of trades. Okay, so now let's look at what that did. Okay, this is one of the tweets I sent out last week prior to me releasing this particular installment of the series. I asked everyone, what do you see here? And it was prior to this move up we were just disclosing. But I mentioned again at the time, I said that supply and demand, which is a concept that's, it's pretty popular these days, but again, it's not giving you everything, and it does not give you institutional order flow. It does not give you institutional perspective. It just gives you part of it, okay? And they teach not to cut through candles. It's a fallacy. Here's that daily low, 146.37. Okay, market dip below it, dip below it again, dip below it again. But looking at in here, okay, what do you see? The question I'm asking is, what do you see going into, let me take this off here so we can see without being disturbed with the chart being jerked back and forth. All right, prior to this move up, okay, there was some institutional interest here for being a buyer. Okay, they bought in here, obviously, and then ultimately went lower. It broke down in here. Okay, when the price broke down, okay, when it was going down into this daily low and interest entering into that higher time frame area where we were expecting some buying pressure to halt lower prices, and that's all below these levels in here. Okay, we were in what we deemed a potential market maker buy profile. So when we see these buying points in the past, even though they have candles that you would have to cut through, in this case here, okay, when we go down to the buying point, when there's a smart money reversal point, like we talked about in Market Maker 6 and Market Maker 7, respective to the buy and sell profiles, when the price starts to go on the opposite end and start moving higher, as we have here in the Market Maker buy program, I'm sorry, Market Maker buy profile, on the other side of the curve here, okay, once we had the reversal point, every time price comes down to an old level of buying, it should be supported. So if we see that on the left side, okay, obviously there was a buying pressure here, okay, and it gave up the ghost, yes, but that's fine. We know at a later time on the other side of the reversal point, those buyers, because think about what I was talking about all this time. Over the years and years I've been teaching, smart money traders buy early. They have to. They have to work in their positions. They're hedging in as it's dropping. This is a hedging point where they bought some, dropped down lower. That position they bought here is underwater. Yes. The position they're holding here is underwater. Yes. But look what happens over here. They get into that same area, they reclaim or responsor and recapitalize the buying that was taken here. They add more money to it here because now they've done the turn here. They bought it here again near the low. They bought it again here. Price rallies up through a level of resistance. Okay. What's it do? Drops back down. Why is it reacting here? Over here, there was buying pressure. The longs that they assumed here that were underwater all this time is now going to be reclaimed. They're going to re-sponsor this bullish order block, and they're going to build positions in on that as well. And it rallies on up and comes back down into what? Another area of this consolidation. And let me zoom in because it's kind of difficult to see in there. But this down candle prior to this move up, okay, that's another bullish order block. And what are they doing? They're reclaiming it and capitalizing that buying opportunity right here for what? The continuation higher and into that area that we discussed just a few moments ago here. This is where they distribute it. Okay, can it go higher? Certainly, but this is what we do. We measure the buying pressure, okay, and interest based on what the buying pressure had done in the past. They're clearly noted, their fingerprints, their footprints, okay? And yes, you're cutting through candles to see them. You're cutting through candles to see them. Supply and demand is a load of baloney in regards to not cutting through candles. You're never going to see it like the banks are operating. Okay, you're not getting this from a ticket runner perspective. I'm sorry, I don't mean to be rude or arrogant, but I'm telling you, when you're working with the bank traders and you're seeing what they're doing on a daily basis, this is what they do, and this is how they recapitalize old buy points. Okay, and that's it. This is how it's done. Okay, um, if you were looking at just this, okay, and say for instance you were looking at the idea that classical support resistance, okay, this is why it frustrates folks that trade support resistance. Clearly the high here, clearly the low here. So if price comes back down to that price point, they're going to be a buyer. Well, that would work. It would work. If it went down there and you would have been buyer and it unfolded as it did, it would have worked. But they don't want every Tom, Dick, and Harry on this move. They don't need it because the real price points are over here based on what we just described. Okay, so we have a market maker buy profile, and all the price points that I taught in 6 and 7 of this series All of those are respective on the other side of the curve. Okay, so as you distribute down here, the little blips and buys, okay, they're going to be reclaimed and responsored on the other side of the turning point. And that's how you identify and map out where those price points are. See, it's not that I'm looking at the chart and saying, okay, well, here's where I'm going to draw a box here, and I'm going to draw a box here because it happened in hindsight. No. What I want you to see in this example is every time you see a market maker profile, buy or sell, look at the price points where the bullish order blocks take place as it's dropping down in a buy program, or the buy profile rather. They're going to be reutilized on the other side as they reaccumulate. And that's the key that you don't get just looking at price and support and resistance or supply and demand. Okay. No other concept out there teaches this stuff. And yes, I'm being flamboyant about it because I'm adamant. I'm telling you that when I got this in my head and I knew what it is I'm looking for, it took away all of the ambiguity about looking at price action and what should I be looking for. Well, now you know exactly what you're looking for. It never changes. It's always the case, and you're just using a higher time frame premise to flesh out that idea. Now again, it's not that you're going in there hunting patterns because you're a pattern trader. Patterns are going to form from the higher time frame levels and ideas that we just described in this video. Having higher time frame liquidity pools defined by ranges, as we discussed, and looking for higher level institutional interest where they had done previous trading in the past, where they've left fingerprints or footprints, if you will, major reaction price points. Okay, when price gets to those levels, that's what you're trading in between. Okay, so if we're in between a major mile marker like that, okay, like a daily low and an area of, um, well, let's go back up to this area here where we talked about. This is that daily low, and between these two price points, this old order block and this daily low, look at all of the opportunity being buyers in here. Even if you're a day trader or a scalper, just focusing on being a buyer with the premise that understanding and keeping in mind that you are still buying inside of a downtrend. Okay, you don't go in and start laying out all your triangles and harmonic patterns saying I'm going to look for bats and bullish butterflies and Gartley patterns and all that stuff just because a Gartley pattern appears in your chart. You have to have a context to frame that idea on, and then your patterns, whether it be harmonic or just simple retracements or even classic price patterns. For instance, we have a bull flag here. Okay, big bull flag right there. Okay, if you understand that, if we take that and just use that idea, I'm going to use the flagpole here idea, okay, and project that from here, you get pretty good symmetry. See that? And you have another bull flag here, up and down. Take that over here and measure it here, extend it from the low. Okay, nice little opportunity to take some profits there. Again, classic bull flag right in here. Measure it. Here's the flagpole, classic flag pattern from the low of the flag, project it up, right up in here. Doesn't get the very high, no. Do you need it? No. Okay. You can draw the flagpole from here to here, project it from here to here, and it would fall just a little bit short. But nonetheless, you're getting classic price patterns still giving you ideas to keep you on the right side of the marketplace because you're working within institutional order flow. See the difference? I'm not framing this on moving averages. I'm not framing this on overbought and oversold RSIs and Williams percent Rs and stochastics. I'm not doing any of that. Okay. But now watch. If you have this idea that you have a range that you're going to trade inside of, and you're going to look for these objectives to be met because the institutions are going to want to be able to get out up here based on what we described earlier. Watch what happens when you do add indicators. Now, again, don't fault me for this. I'm just trying to show you when you do add the indicators, how powerful it is when you use it in the proper context. And let me drill in a little bit here. All right, now we have, let's do our classic 20/80 overbought oversold in our stochastic. Okay, I'm just gonna rough it. It doesn't have to be perfect. Okay, if we're oversold below the line here, okay, you'd be a buyer when it crosses over. Right here, be a buyer. Boom. Right here underneath this this low, it really doesn't get below it. It does on this level here, but I like when both lines go below if you're going to be an indicator trader. Here goes below it and both lines cross over. You want to be a buyer, gets the low. Here's a good one crossing below, and you had to sit through a little bit of consolidation and it takes off. We went below it again here, crossed over, and a little bit of a bounce. Okay, but if you look at divergence, if you're a divergence trader, you have a nice divergence with the lower low here, and then the stochastics diverges bullishly and below what would be deemed as oversold, crossover, and there's your entry point. Okay, um, that is how you use indicators. If you're going to use indicators, that's when they're going to work. Okay, but if you just look at every single time they're oversold, just because you see it oversold doesn't mean anything. Okay, it doesn't mean it doesn't mean anything at all. Okay, but when you have an understanding of institutional order flow, you'll know based on the concepts we've shared in this video, and you start applying price patterns. And one I like is the stinger. Okay, and um, another one is ICT Holy Grail, and I'll talk about them. You've probably already seen a video where I use that, but it's blending patterns within another pattern, and I'll just show you one here. We have a low in the stochastics here, and we have a lower low than this one here, but the price is high, and also look, we got a divergence bullish. So what we have here is a type 1 bullish divergence within a type 2 trend following. So you have a low with a higher low here. Price is moving higher. We have a bullish divergence, what everyone understands is classical bullish divergence. Then we have the stochastic is lower. Okay, so this is trend following in nature. So when you see that, this is going to be a really strong buy. And you can see it had really no retracements from that price point at all. It just kept on going up into the area where we did anticipate. Now, again, that's just to illustrate the proper use of mathematically derived hindsight indicators. Okay, they're useless to you, and really, what we described already. Okay, this is useless to you. You don't need it. You have already have you have no need for it if you understand what was already described in the video. But I tossed that on there just to show you that yes, indicators are useful when you use them properly, but you don't need them. You do not need them. If you understand price action, you absolutely have no need for them. But now, when we have the idea of looking at price with an idea of accumulation underway, we have a low here in the euro, and actually, let's go out to a weekly just to build some understanding of why this would be even suggested. Okay, we have a nice low here. Okay, and price reacted. Okay, prior to it, we have a low here, and then here, all this price action. This is an area to anticipate institutional interest in the fiber. Okay, going back to a daily, and we're gonna zoom in. Okay, we have the down candle prior to the move up. So we could have anything below here is a buying opportunity and still be above this low. Okay, and at the same time, we had the British pound, and I'm gonna have to take all this stuff off to get it, but that's fine. We've already talked about everything we need to be talked about as it relates to that pair. Okay, and I'm going to draw that daily low back on so you can see where I got it from. We have this low right here. Boom, 146.37 right in here. Okay, and we had a lower low here on cable. You see that? Fiber was not. Okay, so somebody on a large scale was coming in and accumulating in the market. At the same time, the dollar Let's go out to a daily. Same time, the dollar was unwilling to make a higher high. Now, it does not mean we made a high and top in the market on the dollar. I'm not suggesting that, okay? But for the near term, it gives you an indication that we could expect at least a bullish bounce in the fiber and cable. But look what's happening. Cable went lower, yes, okay? But now let's drill in on this recent low. Let's go down into a hourly chart. And I'm going to show you how you can actually see accumulation as it happens. Okay. And now we're going to go down to a daily on the fiber, moved into an hourly chart. Okay. And it's nice because I already got that line here. As we made the lower low here, okay, and then we bounced. We came down, made another low. It did not go lower than that low. The prior low is here. Okay. I'm not noting a head and shoulders inverted pattern. That's not what I'm doing here. What I'm showing you is accumulation. The market makes a low, bounces at a level of support where we would anticipate support, retraces back into a down candle bullish order block. Okay, we're right inside this bullish order block right here. The low here is made lower here. So we were able to go lower than we were here. Now watch what happens. It doesn't always work, but when people ask me, how do I know which one of the pairs I'm buying when I'm looking for SMT divergence? And if you don't know what that is, you didn't watch my other videos, and I'm not teaching it here. Haha. the If you're looking for which pair to buy when you're bullish on correlated pairs, the reason why I buy certain ones is what I'm showing you right here. And you'll see that it works more times than it doesn't, but you'll see in a second. The high is 315 pips from the low here. Now, are you going to get every single one of those pips? No. But the range is 315 pips from the low here. Okay. Now, watch what's happening from this low through the low, this point, and then the retracement. Okay. The low is lower here. Okay. So it's down. Even though it does react, it's from this low to the low here on both ends. Because what we're doing is we're measuring market structure, relative strength. What? Not RSI, the indicator. I'm showing you how to measure market structure's relative strength. You're not going to find that in any books, are you now? Watch. Let's go back out to the cable. Same thing happening here. We made the lower low than we did here. But look closely. This low didn't go lower on the heels or the right side of the low like we see in the fiber right here. What does it do? It makes a higher low. What do you think that's indicating? This is suggesting that on an institutional level, there's a more aggressive buying program going on in the cable versus the fiber. Well, let's test it. If we take our little trend line from the low here, draw it up, drop it, and then pick it up again, and you'll see the line. See, it says 139 to the right of my cursor. And now we're up to 200, 315, 400, up to the high of 448 pips. Okay, you see that? 448. The fiber moved what? Did it move 448? No, 315 pips. So which was the outperformer? Cable, clearly. Now, this technique I morphed into by a concept that Larry Williams taught, and you'll learn it when we talk about his concepts when I blend in with my swing trading, and we'll talk about it also when we talk about stocks and commodities, where we can find the strongest out of all the industry groups and sectors and commodities, which will be cool for a lot of you guys that like to trade futures and stocks. But nonetheless, what it does is it helps ferret out the outperformers and the laggards. Now, why does it work? If we understand that we are in an area of anticipated retracement, or maybe even a long-term high or if this is in a bear market and this was a retracement up to a level where we anticipate some selling, um, if we see the scenario like this where we don't see a higher high in the dollar, well, that should be seen with a fail to make a lower low, like we see here in fiber. But look what happened in cable. Boom. See that? Huge disparity. Huge disparity. There is a crack in the correlation, even though we didn't make the lower low in either one of the pairs, respectively. The fact that we didn't see the lower low in cable here that we saw in fiber is a huge indication that there was a lot of buyers in the British pound and sellers of the dollar. Even though that the fiber moved up in sympathy, and yes, it would have been a profitable trade to hold that, the laggard is the fiber and the leader is cable. Looking at the hourly chart on the dollar, so we can give a indication of how it looked on both the dollar and its counterparts, fiber and cable. You can see that we had a failure to make a higher high. That's fine. And we saw that with it here as well. That's respected. And that's respected. But now look inside price action, inside it. Looking at market structure, and no, you don't learn this on any other website or YouTube channel. This is how you deem accumulation. Even though it's only expected to see a retracement, and we didn't ultimately call a high in the dollar because it still could go higher. The scenario that we see here is the buy profile, market maker buy profile or model here, and you see the market maker buy model here. You see the market maker sell model here in the dollar. See that? Pretty neat, isn't it? So when we look at price, we're not looking for patterns. We're looking for institutional order flow in institutional areas of previous interest of buying and selling, looking for the reaction points. We're looking for range contraction to anticipate range expansion. Okay, and we look for those to blend. There's a confluence of all those factors that come together. When you do these types of things, and then you add, for instance, the calendar, you guys should be looking at that every day, okay, at least once a week before the week begins, and make a notation on what high impact release is going to come out, what market driver is going to come out, what time of day that's going to happen for particular currencies that you trade. And you can anticipate the volatility injections that are created by those market releases to fuel you a move into these areas as we've described in this video. And then your trade will form on that framework. So there's a combination of all these ingredients that come together. And yes, we're getting closer and closer and closer to what will be described as specifics of step by step by step in 9, 10, 11, and 12 volume. But right now, you just got another insight that took you light years ahead of the retail universe, and as it relates to price action and how to look at accumulation, how to look for reclaimed and responsored order blocks, and how we use them in blending with market maker profiles, sell and buy, and how we look for higher level time frame charts to help us aid in directional premise and work within counter trend biases like we just disclosed in cable. So with that, guys,